M. Solomon here. Thank you for that wonderful introduction. Let's get going. Got a good presentation for you today. We're going to talk about the disguised sale rules. This has to do, as you can read the detail there, this has to do with conversion. We're going to isolate the lost note today. We're going to show you where it is. When you take that note and you convert it into shares, you must say goodbye to the note. The note has been sold. That is, that is for all intents and purposes the scam that's being run here, and that is that the note has been tendered, it's been destroyed, and that falls under the IRS disguised sale rules for a final sale. You can't bring the note back into the equation at any time because you have shares, and those shares have been tendered, okay, in exchange for cash. Where do you think the cash came from? You purchased those shares, and they were placed on deposit. We're going to get into that. As you can see, the appropriate sections there are 7073B, 721, and of course 731. I also would include 751 for a constructive liquidation. Let's keep going. So we're talking about a lost note. It was converted into shares. That's the first thing you got to make in your ask your attorney to consider in your pleading. I, as an expert, will testify in that case if you so like, but you need to emphasize that the note was tendered for shares, and those shares at the end of the term are worthless. Here's how they do it in a disguised sale. You take the note amount. This is an actual case, by the way. We take the note amount. Got to have my trusty laser there. Take the note amount and add to it the down payment. That could be a second, or that could be a second HELOC, line of credit, or cash. In this case, it's being treated as cash. Let me see if I can get that just a little bit. There you go. So add those two together, the loan amount and the down payment, and you get a purchase price of $732,900. Nothing unusual about that. HUD-1 will support all that information. But now it gets a little bit weird. The loan amount, $586,300, was the same, but the escrow at the last minute changed due to the appraisal and the seller's request. They reduced the down payment from $146,600 by $25. They reduced it to $146,575. And what I did was I said, okay, that's very, very strange. Holding up the escrow, doing a new escrow instructions based on a $25 adjustment. That's called padding, folks. That's what you do in an escrow. You pad it, and that's what serves that purpose. But they said, no, they want to reissue the escrow, and they reduced the purchase price and the down payment by $25. If I reduce $146,600 by 25, hey, look at that, $146,575. You don't need to be Copernicus or a mathematician to figure out how to reduce something by $25. Don't be afraid of the math. But if you divide the $146,575 reduced down payment by $25, look what I get. Red flag, 5863. 146,575 divided by 25, which is a reduction in the down payment. 5863. Does that look familiar? Well, you got a loan amount for $586,300. If I divide these two out, it gives me $100 par price per share. So you can see the conversion of the note through the down payment is converted into $586,300 in par price shares at a par price of 100. At this point, the note is gone. Okay, well, will a judge believe it? I'm not here to tell. I'm here to show you what they're doing. I'm not here to ask you if a judge is going to believe it or not. I'm saying this is what the math and what the general ledger will show if it's discovered, and if discovery is requested. It's showing that the note was converted into five $100 stock. That's a par price for a total number of shares, 5863. Does this sound like really way out there? This is paid in capital. If you ever started a business, you're going to have to do this for yourself anyway. It's not that hard to handle, okay? Or it shouldn't be that difficult to understand. So the purchase price, if the purchase price is $732,900 and they adjusted the down by 25, you'd adjust the purchase price by 25 is what they did. Which is what they did on the HUD-1, and the $732,875 is the adjusted purchase price. If we now divide that as a future value by 5,863 shares, that gives me a closing price of $125,732,875. So the value of that stock at the end of the foreclosure is going to be $125 per share from $100 par price. Okay, now let's recap. Who paid for the stock? Well, your wire in was for 586.3. Do people understand that when you get a loan, the money has to show up from somewhere? And that comes from a wire, bank-to-bank wire, ABA wire. So the escrow officer is going to wait until she receives confirmation of the wire. She can't give you the keys till she has confirmation because she can't disperse. So disbursements are made upon the confirmation of the wire, and that's when you're going to get the keys. So the wire was coming in for 5863. Somebody confiscated that wire or did a net funding. And they took that wire and they took that cash and they said, thank you. Let's just assume it's the lender's successor who's going to buy the loan. So the 5863 is the wire that never made it. So the 5863 is a deposit now, which is offset to the wire, which means you have a zero balance. Nobody's going to pick it up in an audit. So on the maturity date, we said the purchase price, and this is called a reverse purchase and sale. They're buying the home at the end of the foreclosure, not at the beginning where you're buying it. You're buying it at the end. So it's called a reverse purchase and sale, where they record on the 16th of December of 2005, but they book as the sale 12/16/16, and then accrue back or credit back the difference. So that's what's confusing everybody. These are called a reverse purchase and sale. And they think by doing a repo, a reverse purchase and sale, that they can now reconstitute the note, like it can now novation, reappear. You can't do that. It's impossible. That means that the whole deal is being scrubbed. They pocket the money. Everybody's gone. They're going back to the original case. You think those attorneys that you're going against are crooks and criminals. They don't know any better. They are pleading cases without having any knowledge of what's really going down. They just think it's a conventional mortgage. And the rest of society thinks it's a conventional mortgage too. They think you're crazy for not making payments. They think you're crazy for even thinking you've got a case, because in America, everybody has to make their payments. Not in this case. Your wire never made it to escrow, and it was used to purchase stock. And the stock at the end of the term was worth what? Zero. 751, constructive liquidation. All properties are sold for zero. So at maturity, they have to reconstitute the purchase price, which would be a debit of 732,900, and that based on a liquidation of 5,863 shares, which means who's going to pay the funding for that loan? Who's going to fund your loan if it never funded? The person who purchases the shares when you're gone. That means the house has to be sold by you as shares to the next person. So that means you've got an SEC broker transaction, which says you are an integral part of the transaction. Do you get what I'm saying? Listen to me. Get off the fraud. You are an integral part of the transaction, which means you're sitting on shares for 5,863 shares, which are valueless, zero, and you're going to tender them to somebody for 732,900. You're going to get the cash and say, oh, here, lender, here's the cash back. Lender's going to say, okay, here's your home back. They don't do that. You say, lender, here's the cash, here's the shares back, give me my title. You're not saying that. You're going to get a 1099-A for abandonment. You abandon your claims because you didn't properly request the proceeds from the tender. That's on a zero basis. So you are the novation. Let's see if we can wrap this up. The lost note is a conversion of the lost note is based on the conversion of that instrument into shares. So the shares we said were based on a purchase price of 732,900. That wasn't the house. That was for shares. Well, then where's the house? If they're wiring money and you're buying shares, where's the property? The property was taken and placed into trust. It was converted to shares. Where do you think the shares are coming from? Hello. So the trustee sold you back the property, and it was at a discount. And the discount means it's actually at a premium. It was discounted. So the premium would be 881,650.53. That I got from the demand for payoff. There was a yield. The first investor's yield was 100,000 to 781,631. I got that off the foreclosure balance at filing. There's a third tranche. They call it the third level of investment, 163,625 risk proportionate. And that would bring the adjusted sale price now down to 618. That's the Ocwen statement that shows the amount of the outstanding principal balance. Then you have the yield for 31,705.81. That would bring us down to the original note amount. I verified that. So we verified purchase price, demand for payoff, foreclosure balance, the Ocwen statement, and the original note amount. And then we liquidate it to the principal balance and the outstanding principal balance in the deposit account. It's your money, and you got zero. There you go. The lost note is a zero value at the end of the foreclosure term. Let's wrap it up. Once again, recap. You need a loan amount. I need a down payment in order to do my analysis. That'll give me the purchase price. You saw what we did here to convert into shares. That's called conversion. The wire in, 586.3 is the controversy. It would never made it into the disbursement, which means they deposited the cash. That means that at maturity, someone's going to owe $732,900 to you, and that is why we went from zero now back to $732,900. That's called a recertified value or reconstituting the value. You should see that in your pleading or in the opposition's pleading. You then have a discount, and that's a discounted value off a bond. $732,900 equals $881,650. These numbers here are all the adjustments. Those adjustments are reflected in the statement, in the demand for payoff, in the original note amount, and in the amount, demand, foreclosure balance, statement, and original note. And when we reconcile all of these numbers, we end up with zero. In a foreclosure, you call it, in these foreclosures, the legacy program, they're called a constructive liquidation. All properties are sold for zero. Get this through your head. All properties are sold for zero. In a constructive liquidation, your foreclosure is going down at zero, and they need to recertify value because you're not making a claim to purchase back the home at a nominal value. A nominal value would be $100. If I already went through this, I'm repeating myself, but I had a case that I testified in White Plains, New York, and it was a federal case, and the judge said, "Why are we here? This case has already been decided." The man went into foreclosure and sale. I said the individual could not get a modification, nor would they allow any kind of a workout to let him have some kind of, for affordability purposes, give him something like a short sale, okay? And he said, "Well, what do you want me to tell you? That's the lender's prerogative." I said, "Yeah, but then the house went to sale for $100. Judge chuckles and he says, "Say it again?" And I said, "Yeah, it went to sale for $100. He said, "You tell me that house that went to sale, this house went to sale for $100 and they wouldn't give your client there a workout?" I said, "No, they wouldn't give him a break." He said to the opposing counsel, which I noticed was a substitute attorney for the day. He said he didn't know any better. He wasn't thinking. He said, "Counsel, how much did the house sell for?" He said, "Your Honor, it sold for $100, sir." The judge says, I said, "Yeah, you see, it sold for $100. So he said, "We're going to stay the matter. We'll come back in a month from now, 6 weeks." I don't know whatever happened in that case. The attorneys took it over. Anyway, so all properties are sold for zero, which means you are the reversion and you have a right to execute that reversion value at a nominal value, which would be $100. Tender. Now, if you don't, they're going to say that the wire in was reflected as that amount. They're going to reconstitute the note. They're going to say the foreclosure sale was based on $881,650, and they're going to say, "Judge, that person, she or he's a deadbeat, and they owe $295,350,63 in back payments," which is not true. That's called appreciation in stockholder value. That's your money, and they're saying you're a deadbeat. So what you want to read here on the bottom is, at sale, the buyer purchased the demand for payoff, okay, and stepped into that party's shoes. That was dated 9/7/19 for $881,650. I can corroborate that. I can show that at a discount of $100,018.91, which would be equal to the value they show on the foreclosure at the time of the judicial filing, which was on 12/16/16. Got a noisy fan here. 12/16/16 for a loan that originated in 12/16/05. How do you like that? 10 years to the mark. So it's important for you to understand that in a 751 constructive liquidation where there's a partnership involved, the bank are now general partners as their officers and directors. And if you want to take this to the next step, we'll put this in the next video. If the wire never made it into escrow and the note canceled out for zero, then you have the cancellation of debt by involuntary conversion. They took the title. And by taking the title, they used the nominee to sell it back to you. So the nominee is the seller, not the lender. The nominee is the seller. But if the property is free and clear, because I just showed you a wire in less a deposit in cash gives you a zero balance. If the property is free and clear, then that means that the seller is carrying back the paper, which means MERS is the seller, and it's a incident to being a lender, but is the lender because it's representing the seller's equity that's being carried back, and you're in financing an installment sale to you. That falls under the installment sale rules. Are you starting to get it? This thing is by design. People say, you know, my deal's different, my case is different. It's not. It's called the legacy program. Some people call it the Saudi Arabian, I forget what it's called, the Sharia law. But this is, everything's done now on the installment sale arrangement where there is no interest other than an interest in the ownership of the title. And that's what you got to understand. But the most important thing is all properties are liquidated to zero, and the note was destroyed in exchange for the cancellation of debt. You have an involuntary conversion of the title over to MERS, and MERS selling it back to you. If you have any questions, I can be reached at area code 202-550-8364, 202-550-8364. And you can also email me at secondarytradedesk, just like it sounds, at gmail.com. secondarytradedesk@gmail.com. I moved fast, very fast, and that's because people have only so much time in a day. It's not important. We say it's not important to understand the math. It's important to understand how the math is being used. And in this case, you have a general ledger that is very, very easy to decipher. And if we have to go before the IRS on your behalf, we're willing to do that, whatever it takes. The proper characterization of a transaction is the most essential thing you're going to plead. I'm not an attorney, and I'm not representing to be an attorney. Only an attorney can represent your rights and title. But the proper characterization of a transaction is the first and foremost pleading in a federal complaint if you're going to bring it there. So I look forward to talking to you. You can reach me again, 202-550-8364. Take care.